subscribe now and press the bell icon. Never miss an update.
So let's just focus on like-kind exchange. And this is obviously the section is 1031, which talks about like-kind exchanges. As the name says, there is an exchange of property happening. The same kind of property is being exchanged. Then we need to see what is the gain or loss on that exchange. There may be more than property, there might be some more things involved there, like when you're exchanging the property, maybe there's some consideration given in the form of cash as well, or some other properties also given, or it's either given to the other party or it's given up by the party. Okay, so we'll have to take into consideration what are the total properties which are exchanging hands, and should we take the basis, shall we take the market value, how do we adjust the other items which are given in that transaction. So first of all, section 1031, it is not about exclusion, it just says it differs recognizing gain or loss. So basically we are not going to recognize it in this year, but it is getting deferred. Maybe some other year it will get, it's not a permanent exclusion. Okay, it's a deferral. To the extent that real property used in a trade or business or held for the production of income. So it is only applicable to real property, this section. So that means neither personal use property nor inventory will qualify for this deferral. We have to see if there's real property, which is exchanging any real estate kind of property, exchanging hands. Then we can see, can we apply this like kind exchange rule? Is there any gain that can be deferred? Can it give some kind of tax benefit to the taxpayer? So realized gain or loss is the gain loss from sale or exchange. Whenever the sale or exchange is happening, let's just focus on the concepts first. Whenever the sale or exchange is happening, what is the gain or loss out of that? That will be realized gain or loss. But now there is a difference between realized gain and recognized gain. These are two different terms used here. Realized gain may be a very big amount. What is recognized gain is what we really need to come down to, because that number would be reported on the tax return and the tax will be computed on that number. So what is the realized gain? What part of it can be deferred? How do we derive to recognize gain? And then that recognized gain should be reported into the tax return. Okay, first of all, what is like kind property? Only real property qualifies, that we have seen. Properties are of like kind if each is within a class of like nature or character without regarding to difference in use. So it is the same kind of property, same class, maybe it should have the same characteristics or same nature, and it could be put to different use, that is fine. But it should be the same kind of property. So I think this is the example that they've given. A real estate lease that runs 30 years or more is treated as real property. Okay, so what they're saying is if it's a long-term lease, it can be treated as a real property, and the exchange of it for other real estate qualifies under section 1031. As long as the parties to the exchange are not dealers in real estate, that means they are not brokers in real estate. When it comes to broking business, that's completely different thing. So any lease which is a long-term lease, that can also qualify for section 1031 treatment. Real property located within the United States is like kind with all other real property in US. So foreign real estate, even though it's same in nature and character and all those things, it will not get replaced by the local US property. Foreign real estate is like kind with other foreign real estate. So if there is a US citizen staying in India, or doing some transaction in India, giving up one piece of land, acquiring another piece of land in India itself, both those property will be treated as like kind. But if they say that, okay, I'm going to give up my property in US and acquire, like get something in India and all, then that will not be considered as like kind, because it is happening in different locations. But within US, it's fine. It's not specific to any state. It's not like if you're taking something in California, you have to do the transaction there only. You can get it exchanged by some property in some other state, say Florida. Okay, boot. Now, this is a very technical term which is used in US a lot. And boot is all non-qualified property. Boot meaning there can be cash exchange, there can be some other property which is given up, which is all non-qualified property, meaning it is not a real estate. Because here we are looking into the exchange between one real estate and the other real estate. Anything which is not a real estate will be a non-qualified property. And this may happen. It's in real life, the transaction will not happen like this, that okay, I will give up one apartment of mine, you give me your other apartment and all. There might be something, there might be like, okay, the value of my apartment is say 100,000, yours is say 80,000, so you give me 20,000 cash also along with it, or give me something else which is like worth some amount, whatever. So those kind of transaction, if there is something else which is given or transacted besides the real estate, then that's called boot. What is gain here? This is an important rule. Gain is recognized equal to the lesser of gain realized or boot received. So we have to first see what is the gain realized. Okay, we have seen here there is a difference between realized gain and recognized gain. So what we will see is what is the gain realized out of that transaction. Then we will see what is the total amount of boot. Then we will see what is the lesser of these two. Compare these two amount and see what is the lesser one. That amount, which is the lesser one, that will be recognized as gain and it will be reported in the tax return, and tax will be calculated on that. Okay, and boot may include like cash or net liability relief, any other qualified property and all. So we'll go through a couple of the examples that will make it clear. So all right, let's go over this thing. Okay, let's see what is the adjusted basis. 50,000. Okay, FMV is getting something back for 60,000, and he's getting cash as well. 2,000. Both 3,000. So this is what he's giving up, and he's getting all these things in return. Okay, this is now Scott's basis in the land received. What they're saying is whatever he's receiving, what is the basis in that land? Okay, so that is equal to the basis of the real estate transferred. This is what he's giving up. So we will again start with what is the basis in new land, property given up, $50K. Where is it? Is equal to the adjusted basis of the real estate transferred less the boot received of the boat and the cash. So we are going to do less boot, which is going to be 5K, correct? Because the boot is 3 plus 2, right? We will come up to 45K. And the gain recognized on the transaction. But what is the gain recognized? We don't know what is the gain recognized. So plus what we'll do is gain recognized, not realized. I'm going to write recognized here. But we don't know what that is. So let's now compute what is the gain recognized. Gain recognized, we will do. What did we read here? Gain is recognized equal to the lesser of gain realized or boot received. Okay. What is the gain realized here now? Lesser of gain realized or boot received. So can someone tell me what is the gain realized?
10K.
What is the total thing he's receiving? 65K. And what is he giving up?
50K.
50,000. Isn't he receiving all these things? All three of them he's receiving, right? And he's giving up only this. So what is the gain to him?
15K.
15K. And what is the boot received?
5K.
5.
What is the lesser of these two?
5.
Right? So lesser of these two is going to be 5. So I'm going to put here 5K, which is going to be equal to $50K. So this is an example where you're coming back to the same amount, but then this could be different as well. Don't think that we have to come back to the same amount of given up. Because here the lesser was 5K. If the gain realized was lesser, for some reason we would have taken the lesser of uh, we would have taken that amount, which could be less than 5,000. Are we able to understand this? Okay, all we are doing is we are going over these rules, and we are trying to apply it here. So Garima, you can read 11.6.
Yes, ma'am. Real property with an adjusted basis of $50K is exchanged for $20K cash. The recognized gain is $10K, which is like 40K plus 20K minus 50K. The lesser of the gain realized, that is $10K, and the boot received $20K.
Okay, can you please explain what is happening here and versus what did we do here?
So in this case, the adjusted basis, the cost was 50K, whereas in exchange of that property, what that person is getting is 20K cash and like kind property of 40K. So overall, that person is getting 60K, whereas adjusted basis, the cost was 50K only. So realized gain is 10K, recognized gain, sorry, not realized gain, recognized gain is 10K. That is the total sales consideration 40 plus 20, 60 minus 50. So recognized gain is 10K, whereas the boot what he is getting is 20K. So in this case, the lesser amount of boot or gain is the gain amount, which is 10K.
Correct.
In
Correct.
previous question, boot was lesser, that's why we considered boot amount.
Yes. Right. So understood. Now here the amount of boot is very high. So we'll have to go with this rule. What is the lesser of that? Okay. Let's look into the next one. You can continue, Raksha.
Okay. Ellen exchanged real property with a basis of 60K plus 5K cash for like kind property with a fair market value of 63K. Ellen's 2000 loss is not deductible. Okay. So in this case, the adjusted basis was 60K, whereas he is getting 63K plus 5K.
No.
No, that's wrong.
No.
No, 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 no.
Alan
Plus 5K.
exchange. He is
Uh,
giving. He's not
giving
getting it.
5K. Yeah, he's giving 5K.
So he's giving something worth 65,000 and is getting back what?
63K.
63K. So there is a loss of 2,000 that will not be deductible.
So in 11.6, Nitika, the now the basis will be 50 plus 10. 60K will be the basis.
50, you're taking the adjusted basis. 50, you're taking the recognized gain. Correct?
Yeah, yeah.
It is 10,000.
Hmm.
Yes.
That will be the basis. And in 11.7,
Wait, property, the basis in new line is the property given up, less boot. No, sorry, no, we have to adjust the boot also. So the adjusted basis will be, the new basis will be $50K, which is given up. Okay, less boot 20K plus gain, which is 10K.
okay. So 40K will be adjusted basis.
Property given up, yes, less boot. We have to deduct that boot amount, plus we have to add whatever is the gain amount.
Okay.
Yeah.
And in this 11.7,
11.7 is the loss thing. Yeah, we can do the basis calculation again, but what they're trying to tell here is this loss is not deductible. 1031 is for deferring gain or loss. Okay, so this loss is not deductible. The gain also gets deferred and the loss will also get deferred. Okay, so we are calculating here 1031 gain or loss, and this is not going to be deductible. That's what they're saying.
okay.
Okay. So let's look into liabilities. Liabilities are treated as money paid or received. Anyways, what they're trying to say here, if any of the party assumes a liability, that is also considered as a boot, because that is something different than just the property changing hands. Here they have given how to calculate the basis. So qualified property received in like kind exchange has an exchange basis adjusted for boot and gain recognized. So we have to see what is the gain recognized here. We are recognizing gain of 10K. What is the boot amount, which is 20K? We need to adjust that, and that becomes an exchanged basis. This is the original basis of the property given up. Then certain transactions are happening which we have to adjust for, and that becomes the new basis or exchange basis. So again, the same example that they're given here, that you take the adjusted basis, um, you do the gain, add gain recognized, add boot given. This is boot given, not boot received. So this is this example that they are giving up the boot. Sorry, the from so if one person A is exchanging his property with another person B, we are just thinking from A side. Okay, what is going to be his adjusted basis? And A is giving up a property of 60,000, plus he's also giving $5,000 extra cash, and he's saying, okay, take my property, take cash from me, give me something back that you have. I'm okay even if this is the fair market value is low. So that is the boot given. That's why we are adding it. Any boot which he's receiving, that gets deducted. So here the boot received, which is $20,000, $5,000. We are just seeing from one person perspective. Both the people will have 1031, right? Because both of them are giving up some property and getting it back. But for our calculation, we are just going to focus on person A. Minus boot received plus any exchange fees are there, less loss recognized, because if we are adding up gain recognized, will also take up loss recognized, and that will become the new basis in the acquired property. So okay, I hope this is clear. That's fine. They're talking about exchange expenses and all. If there are expenses in this transaction, then we have to also adjust those. We will not call them as selling expenses. Usually when the sale happens, what we say is that, okay, adjust all the selling expenses. Here we'll call them as exchange expenses, because there is an exchange of property happening. Okay, then what is realized gain? We have already seen that realized gain is recognized only to the extent of boot received, the lesser of, or recognized gain. It's the same thing, but what we have to follow is, we have to follow this rule. What is the lesser of gain realized or boot received? Okay. Basis in the property is acquired for gain recognized. This also we know this, because it's the same thing we are doing here. We are adding up gains, right? In our example, what we are doing is we are adding up gains. So we are coming up with a new basis. Why we are adding that up? Because we are paying taxes on that amount. That is the recognized gain. We are paying taxes on that. That means we are buying something, or I mean, like that means there is a, like, tax has been already paid on that. So if you don't add it to the basis and you're selling of the property, again your capital gain is going to be higher, because you're not increasing your basis with that amount on which tax has been paid. Same thing, if there is a loss, you are taking advantage of that loss, right? So if you're already taking advantage of that loss in your tax return, you better don't, adjust it again. You don't increase your basis again by that loss. You will decrease the basis. Why? Because after some time, if you're selling of that property, your basis would be low by that much amount. So that means your capital gain would be higher. The adjustment to basis is important, maybe not at that point of time, but for later subsequent transaction. And it could be important for this point of time also, because the depreciation will be calculated on the new basis. Okay. Loss realized with respect to qualified property is not recognized, but loss on boot given may be recognized. So if some qualified property is exchanged, loss realized with respect to qualified property is not recognized. Okay, so this is the same example that they have given here, that they are not recognizing the loss because there is boot involved in there. Because of the boot, the loss is coming. Otherwise, if there is no boot, $60,000 property is giving up and getting $63,000 property back. So actually, there is no loss there. But because this person is also giving up some cash extra, that's why it is turning into a loss. So this kind of loss is not deductible. Loss realized with respect to qualified property is not recognized, but loss on boot given may be recognized. No, so I'll need to check on this thing and I'll let you know. This is yeah, this could be a bit confusing. Let's just leave the loss thing now. Usually 1031 we are always dealing with gains. Okay, so let me just rework on this thing and then I'll clarify it. Okay. Let's look into what is this qualified exchange accommodation arrangement. So whatever, so there are certain time limits on this, that if you're doing an exchange, it has to be done within certain time period, and also like within 180 days the property needs to be exchanged. Within 45 days we need to at least figure out or identify the property that will go for like kind real property exchange. So, and then usually intermediaries may also be involved. What happens is that we can, instead of dealing directly, we can give that property to the intermediary, and the title may also be transferred, and that intermediary will do the rest of the transaction. So that is also allowed. What they are saying, that certain requirements must be met, that there has to be a written agreement and time limits have to be still satisfied and all. Because if they're really huge transaction involved, like $100 million transaction, $50 million, it's usually they get done through the qualified intermediaries, who could be bank, who could be some other title companies which can hold the title for you, make sure the transaction is done, and then you can take the 1031 gains. Any exchange expenses, if there are there, we have to subtract them. We have to definitely make sure, like how we would subtract selling expenses to compute the gain, the same way we will also be adjusting exchange expenses. Any related party, if the transaction is happening between related party, they have put certain condition that the taxpayer cannot dispose of the property within 2 years. If there is a related party transaction, it's not like you are doing 1031 now, you're deferring your gain and you're again transferring it again, like within 2 years. Okay, so what they're saying is you cannot dispose of the property within 2 years. After the date of the last transfer, which was part of the exchange, in order not to recognize any gain. If you have taken the 1031 advantage, you're not recognizing any gain on the initial exchange. And if the transaction is done with related party, then there is a restriction that you cannot do it again The same property cannot be sold off again for next 2 years. Who is a related party? Again, we have seen all these things, like who has more than 50% control and all, that could be considered as related property. Multiple parties can also be involved. If there's a huge property involved, it's not like one party will come and take away all of it. Maybe there is like one party giving up one property, but there are five other people, five other parties coming up and they're exchanging their property and all. So that is also possible. We usually report these kind of transaction on 8824 forms. These transactions are not very, very common, like very big, investment companies or manufacturing concerns and all, who are like, who have a lot of those real estates and all, they would usually get into these transactions. Reporting needs to be done. Obviously, we are already talked about form 8824. We need to do proper reporting. We have to put in all these details. What is the property exchange? What is property given up? Any related party, if there, it has to be marked properly, and all those information, which is pretty regular, right? Anywhere you're going to report the sale of the transaction and all, we have to give all these details. So there's nothing new over here. Holding period, if the property received in an exchange has the same basis in whole or in part as that of the property given, and if this property is a section 1231 property, what they're saying is section 1231, if you remember, that's for long-term real estate only. So what they're saying is, if it's like the property received has the same basis in whole or in part, it has the same basis, and this will qualify to be a section 1231 property and all, then the holding period will be the same. It will include the period for which the property given was held, meaning we will take the holding period, original holding period, even for the new property. It's not like we are again recalculating the holding period. Why holding period gets so important? Because again, you'll have to wait for a year or two to make sure that it becomes from short term, the transaction becomes long term and all. Okay, so we have this is like kind exchange process flow chart where a qualified intermediary is involved. So these are the parties. This is the taxpayer. What taxpayer can do is they have been given a timeline that within 45 days you need to identify the property. Within 180 days, the replacement property should be received. So this intermediary, it could be a company, it could be some kind of investment company or title company or whatever. They are basically doing this transaction for the taxpayer. So what they'll say is like there will be a transfer agreement between taxpayer and intermediary. So intermediary becomes the beneficial owner because taxpayer has transferred the property, and taxpayer will get a replacement property. Taxpayer is giving up the property. Okay. Then there is other things happening. The intermediary will not keep the property with them, right? They're like banks and also they'll probably find, or they're like investment banking companies. They'll find a buyer, they'll find a seller, and they'll do this transaction. But what they're saying is the transaction has to be done within so much time, because it's not possible for the taxpayer maybe to do the transaction between 180 days. It's difficult to go out and find the same kind of property and all. But these intermediaries, they may have a lot of buyers and sellers which may have same kind of property. Right? So they may have some, they can facilitate the transaction in an expedite way. Okay, that's again the quick recap of what we have done. Realized gain or loss. What is realized gain? What is recognized gain? How do we calculate the basis of the new property which is received? So if it's not like kind property, we just take the fair market value of the property given up, meaning the fair market value of the property which we are getting, adjusted basis. You just do a quick, comparison between these two and see what is the property, what is the gain or loss. What is realized gain or loss? In realized gain or loss, we have to see what is the boot Any other adjustment that we need to do? So we have already seen what is the realized gain. With what we will do is we will take the adjusted basis of the property given up. We will see all what we are receiving back for that property, do a comparison, and see whether this transaction is giving a gain or it is leading to a loss. That will be realized gain or loss. Out of that, how much is recognized, that we have to see lesser of boot received or realized gain. Is this number bigger or the boot received is bigger? Received, not boot given up. Okay. And then that, so the remaining gain, this will be the recognized gain, and the remaining gain will be deferred. So what is our realized gain? That could be, say, that could be $100,000. Recognized could be only $50,000. So the difference between these two, the other $50,000 will be deferred. We are not recognizing it now for the purpose of taxes. What is basis of acquired like kind property? Again, we have already seen how to calculate the basis. What they are saying is subtract line 4 from 6 and 9. What is 6? Yeah, adjusted basis like kind property given up. So we start with the basis, adjusted basis of the property that we are giving up. We will subtract the boot received and we will add up the gain realized. That's how we have done it. Subtract line 4. So boot received we are subtracting from the sum of lines 6 and 9. We are adding and we are adding up recognized gains. It's the same thing. Maybe if they're giving up in this format, maybe you will get confused, but it is the same, exact same thing what we have seen here. What is the basis? The adjusted basis of property given up, plus we will recognize any gain which is recognized, we'll add that up. Any boot that we are receiving, we will deduct that. These are the 3 items that we saw in our example. And it could also be possible that taxpayer A is also giving boot with the property. Then we have to add that. We have to just give the opposite treatment. And there is a loss which is recognized, then that needs to decrease the basis. Okay. So anything else here? No, with that, we have finished off chapter 11, unit 11. We saw 2 different sections here. One is the sale of principal residence. One can claim exclusion of up to $500,000 if all the conditions are satisfied. Second is this 1031 gains. How can we defer that? So that section 121 is a permanent exclusion. It's not going to come back anytime. It's given, meaning given. $500,000 benefit given forever is given. IRS is not going to come to you and say that, okay, we gave it 3 years back, now you need to pay taxes on it, because it is not a deferral. But 1031 is a deferral. What they're saying is, okay, right now you do not put that up for tax, but the basis will be changed. So again, if you're doing the transaction for the same property, there could be gain or loss recognized. It's just deferring it. They are not saying that up to the extent of $1 million, $500,000, you don't have to pay anything. They're not saying like that. What they're saying is, if if certain conditions are met and if you do all that calculation, if your realized gain is more than recognized gain, then you can defer it. The difference between those two. Okay. So we'll close it here now. Any questions, any comments?